It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today with us, we've got Andrew Toop. He is the CFO of 4Front. Andrew, thanks for being on the Talking Hedge.
Josh, thank you for having us. Really appreciate it.
I appreciate you being with us. Tell us a little bit about yourself, how you got into the industry, all that good stuff.
Yeah, so I started my career, in the mid-90s in finance. I was a, very junior investment banker here in Boston. And then I spent the next 20 years after I left investment banking as an analyst and portfolio manager looking at small cap growth companies. I was an equity analyst. Started at MFS here in Boston and then the bulk of my time at BlackRock. And how did I get into the cannabis industry? So in 2013, I left BlackRock and I was looking for something new to do. And one of my friends, Josh Rosen, who was the founder of 4Front, was looking for investors and he was looking for talent to bring into the industry. And so I sort of scratched my head. This was even more taboo in 2013. I sort of looked at my wife and said, geez, am I getting into the weed industry? And she looked at me and said, why the hell not? Like, give it a go. And so I made an investment in 4Front, and then I jumped full-time into the business in 2014. 4Front was originally started as a consulting company. And, shortly after I came into the business, we sort of said, well, if we're really good at winning these licenses on behalf of consulting clients, why don't we just do this ourselves? And so our model became not unlike other MSOs where we were going after de novo licenses and limited license states, trying to, do little tuck-in acquisitions here and there, trying to get a bigger addressable market to, for the portfolio.
Before I dive into multi-state operators, MSOs, kind of the rise and fall of MedMen, when you got in, Boston wasn't an opportunity. Massachusetts, really didn't have a market. A lot has happened. So before we get into kind of, East Coast, West Coast, expanding or emerging markets and existing, I want to kind of dive into BlackRock. You were there for over 10 years as a fund manager, portfolio manager. And so I'm curious to know your opinion on the phrase cash is king, what that means to you, and is it relevant to the cannabis industry?
I think it's very relevant. One of the interesting things when I sort of take off my 4Front hat and put on my investor hat and look at this industry and how it's laid out, you made a great point up front. When we first started in the U.S., the big mantra was how many states can you get into? And when you looked at a comp table talking about valuations in cannabis, next to the 4Front name was, how many states they were in. Are they in 10 states or 7 states or 14 states? And that was supposed to be some proxy of, what your multiple should be or what your valuation should be. And capital formation in this industry, this is a capital intensive business, and capital formation has historically been really hard. So if you are in 14 states trying to raise the capital to build out operations across that footprint, and then having enough operating talent to come in and run it effectively is really, really hard. And so your observation earlier, we had, if you go back 3-4 years ago, the clear leaders in the space were in the US were, I would say, MedMen, Ianthus, and Acreage. And they had these massive footprints. And I think is what's so interesting about where we are in cannabis right now is because we had a big liquidity crunch in 2019, and it really shook people out. So the folks that, were, more of the promoters, the carnival barkers that didn't really know how to operate started to get really, really wobbly. And a lot of some of those folks didn't make it. And so here you go into 2021 right now, where a lot of these players in the industry, you look at the top 10, 15 players in the industry, but most of them are profitable. And that liquidity crunch of 2019 really made people get religion on being profitable. generating cash flow, showing strong incremental margins as you add revenue to the business model. And so why I think this is such an incredible time for investors is because you still have an opportunity to buy these US names at really reasonable prices, in my estimation, kind of 12, 13, 14 times next year's EBITDA. You have a great regulatory tailwind, and investors are able to invest in companies that aren't just fly by night. These are real tried and true companies that are making real profits. And so when you combine all that with the fact that institutions still need to come in, the BlackRocks, the Fidelities don't own these stocks broadly yet. And I think that's all part of the opportunity that's still yet to come. But having the industry already go through the maturing process of profitable growth, good asset allocation, running a good business, that stuff has all happened. And I think it makes investing in this space, particularly in the US, even more compelling.
Mm-hmm. Yeah, it's a lot easier, I would say, now than half a decade ago, simply based on the fact that, in my opinion, it's very, very difficult to sell an idea, to educate something and then try to sell it. Now that cannabis and CBD and everything is at the mainstream, you don't really have to educate people about cannabinoids and CBD. Therefore, you can just focus on what makes you guys unique or your strategy rather than trying to educate and then sell. I think that's kind of a big push, a maturing point for the industry.
But I think it's been interesting, though, on that point. We've been bringing investors up to speed for 5 years on just the basic building blocks of this industry, what the levers are, et cetera. And just now we're starting to see the Wellingtons, the Fidelities, I'm starting to have one-on-one meetings with those types of guys. And often cases, Josh, like we're getting pretty basic questions from some of those folks. Like, oh, can you not take it over state lines? It's like, no, you can't. And so I'm more than happy to do that education, but you're seeing that second wave of big institutions starting to get up to speed. And I think it's going to hit the market here in the next 18 months.
So you mentioned liquidity crunch of 2019. There's the pre-pandemic, there was a lot of ideas and people were kind of going at their pace. And then all of a sudden, life as we know changed drastically.
Mm-hmm.
So I'm curious how you were able to pivot to stay relevant during the pandemic. There was a lot of sale leaseback options. I think you guys utilize IIPR, if I'm not mistaken.
Mm-hmm.
How did that transition play about? How did you strategize which assets to liquidate and where to reinvest?
Yeah, so we were a company that was very much on the right track in terms of we were focused on operations. We're focused on the limited license states where, we thought pricing was going to be buttressed for longer than, maybe a West Coast state, or where there was unlimited licenses. And we did a lot of things right, but we didn't do everything right. And when we entered 2019, we were closing, an acquisition with CanX, which is, was our Washington assets, and it came with our CEO, Leo Gontmaker. But we had grand plans of, okay, we want to replicate these tried and true brands and standard operating procedures, which we developed in the Washington market. And we wanted to replicate that across our footprint. And that was all well and good, except for, you needed $150 million to do everything we wanted to do, including facilities in Michigan, but a bigger facility in Illinois, and so on and so forth. And so we were a company that when we entered 2020, we were burning $3 million a month. And we had to sort of say, okay, guys, capital is not available in this space, particularly not for companies that aren't profitable, I should say. And we did a lot of drastic things. We cut our corporate overhead by 55%. We took the number of states we were in from 9 down to 5. So we shed assets where we were retail only, where we couldn't be vertically integrated. And we made the switch. We made Leo Gontmaker our CEO, and Leo, I think, is one of the most talented operators in cannabis. So let me sort of spend a minute on that. 4Front, when we started, we were largely, the leadership was finance guys, and we saw the value in these limited licenses, and because of our regulatory expertise through Chris Crane, one of our partners, we were really good at winning these licenses, and we were pretty good at opening up retail facilities. What we found is that we stunk at cultivation and production. So when we looked around and said, well, geez, how do we buttress our skill set? How do we get sharper here? We looked at Leo and his team in Washington and sort of said, this is incredible. They had yields in their facilities, over 350 grams a square foot. They were the number 2 flower producer. The facilities were the number 1 edibles producer in Washington. And they were really profitable in a really competitive market. And so we looked at them and said, these guys, because they've already been through the ringer of price commoditization and high competition, they figured out how to push low cost production. You walk into that facility in Washington, it looks the closest thing to consumer packaged goods I've seen in cannabis. 200 people, 24 hours a day, 3 shifts a day. Turning out 25 different brands, thousands of SKUs of product, all of which are in the top 10 in Washington State in their categories. And so what our thesis is great. So we bring that expertise and those brands that have been so successful in Washington, and we port them into more nascent recreational markets of Massachusetts, Illinois, where we're vertically integrated, and we're entering California right now with what we think is the largest cannabis processing facility in the world that opens in the next 2 weeks. So we're basically taking our low-cost production that we've developed in Washington, and we're putting it on steroids for the California market.
I appreciate you diving into that. I wanted to know, exactly what you were talking about, what you learned from some of those, not mistakes, but what you weren't doing right, and kind of correcting that. There's a lot to learn from that. So switching from retail only to vertically integrated, learning from your mistakes, or learning from Washington. Washington is a giant petri dish experiment. And so cultivation processing, very difficult. As agriculture, there's low margins. What do you think is going to happen on a global scale with Canada producing at $6 a gram and Washington producing at such a low dollar amount? Is there going to be an opportunity for Colombia to come into play for cultivation? What you've learned from cultivation?
I always thought the notion that Canadian LPs were going to be, the cannabis suppliers to the world growing in the Canadian tundra was preposterous. and it's, as those market caps got bigger and bigger in Canada for some of the original LPs, they had to start to justify their market cap by saying, no, we're not just selling to 40 million people in Canada. We're gonna be suppliers to Germany and and it was largely BS. I think that it was sort of market cap justification in my mind. I would argue that yes, you can produce in Colombia for 5 cents a gram. I would argue that we were probably a decade away from the U.S. importing cannabis from Colombia. I think that we're 5 to 10 years away from interstate commerce, and I think that I might be in the minority there. I mean, Boris from Curaleaf is really beating this low cost production interstate commerce theme hard the last couple of weeks, which makes me more curious about what Schumer might say when he finally puts out his plan. But I think we're 5 to 10 years away from interstate commerce, let alone bringing cannabis in from a Colombia internationally. So yes, I think it's going to continue to commoditize, but I think that it's going to be a while before we import. And so the way we look at the industry, you sort of say, okay, well, where's the sweet spot in the value chain? Longer term, like we're really good at cultivating cannabis. We can do it. We're doing it in Massachusetts, close to 400 grams a square foot, which we think is about double the MSO average. So we're really good at it. But we sort of look at it and we're like, longer term, we don't want to be farmers. Like this is commodity stuff. There are going to be farmers that come into this and big, large scale ag in the US that's going to figure out how to grow this really, really cheaply. And so the way that we think about where the sweet spot is in the value chain is it's having low cost products that people love. And we want to be a finished goods producer. And you'll notice that we got into California. We don't have a cultivation facility in California. There's plenty of raw material to feed our finished goods. And so if you look at California, we've basically taken our low cost production in Washington and put it on steroids to hit the California market. And we always say, and this is a big point, Josh, like we think price is our brand. And we are very cognizant that the end markets of cannabis have a lot of price elasticity, meaning that if you can give a customer a great product at a great price and you can make margin doing that, you're going to take outsized market share. Because it's been a big problem. Like great brands came out of California, but if you have a whiz bang saucepan that's the bee's knees and it's premium and everyone loves it, and you have a premium price point, we can come in and undercut that guy by 30%, and we'll take all the share. He can't come down here to our price point and make any money because he hasn't figured out low cost production. And so the way that we think about brands is giving people and taking a lot of market share by giving people quality products at great prices. And we do that across 5, 6, 7 states that are large rec states. All of a sudden we have national brands, and we kind of did it without the gloss. We just did it by giving people a product that's cheap and that they like.
I'm curious about branding because I've got maybe a contrarian view that branding hasn't been established yet. People still go in and ask for the highest price or the highest THC at the lowest price.
Yep.
So is there cannabis branding? You said price is your brand. Price and convenience are the two factors that people choose. When are we going to see a commercial where, it's relative to me that I see it and I say, oh, I relate to that. That's my brand.
Yep.
We're not there yet. When is that going to happen?
Well, I think the only brand in cannabis right now is cookies. Like I think. And so, look at our Washington facilities. So we've got, we're the number 2 flower provider in Washington, where we have good, better, best flower. Funky Monkey's our premium brand. Legends is more of our middle of the road brand. And then we have a popcorn bud brand called Mini Buds. We in Washington State, when Leo started there six plus years ago, everyone said you're crazy, like to go into Washington State rec market. There are all these established medical brands, and they're just it's already saturated. All but one of those are now gone because they haven't figured out low cost production. And so I think we're just very dubious about the celebrity endorsed brands. No one's walking into my Georgetown store in Massachusetts saying, give me the Willie's Reserve. They're just not. And so what we're seeing is after 6 years in Washington with close to 10% market share out of our facilities, we are finally having retailers come to us being like, yeah, we can take up price on these brands. People are saying Funky Monkey. Like, we know it's been really consistent. I know what I'm getting. They always have good premium strains. It's always at a great price. So, long-winded way of saying brands, after 6 years in Washington, we're finally seeing brands start to matter. And I think that's probably a pretty good timetable. So as you go to Massachusetts and you go to California, like, people hop around from brand to brand to brand on price. And it's going to be a while until things commoditize a little bit and the market shakes out a little bit before I think that you have the opportunity to establish brands, not just selling low THC.
Mm-hmm. The other thing we were starting to see a lot of before this whole pandemic was a shift towards profitability, clean balance sheets. You had mentioned early on that you guys had a $20 million monthly burn rate, but a 10 to 14x EBITDA. So I'm curious about where you're looking at in the future. Are you looking for emerging markets? Are you going to take advantage of distressed assets on the West Coast? And where's BlackRock looking?
So we are, yeah, I mean, the industry shaped up. We shaped up. We got profitable within 9 months last year. And we got our balance sheet cleaned up where we're in a liquidity position where we've got, close to 20 million in cash. We've got closely held debt that's not due for 40 plus million in closely held debt that's not due for another 2 years. So we're feeling good about our balance sheet, but we think that the opportunities right now, we want to get deeper into the states we're already in. So we want to be, in Massachusetts, we're opening our third retail dispensary next month, pending final approvals from the CCC. But we only have 15,000 square feet of canopy in Massachusetts, and our aspirations, and that's basically only feeding our 3 stores. And our aspirations are to be wholesalers in the state and to be able to give our finished products and produce our finished products and have them distributed across, all dispensaries in the state. So we have aspirations to go deeper into Massachusetts and Illinois. We obviously, want to make sure that we nail this California opportunity. And I think, and we have a license pending in New Jersey, which we hope to hear on in the next, we're hearing in the next 30 days, but my fingers are crossed. So yeah, we might add on another state. We're feeling like we're playing on our front foot. We're feeling like our operating team is really clicking on all cylinders, and we have some confidence in our thesis of taking what we did in Washington and replicating it in other states. We're starting to see proof of concept in Massachusetts and Illinois. So that confidence that you get from being successfully deploying your brands and SOPs, it makes us want to spread our wings a little bit more and maybe add in another state or 2.
Can you dive into that at all? Can you with first quarter earnings out? If you can explain, maybe where you're at with that and what you're going to do in the future, if there's New Jersey or other markets you might be looking at.
Yeah, so our first quarter was, terrific. It was really driven by, our retail locations outperforming. We grew sequentially 26%. We did 31.4 million in revenues or system-wide sales in the quarter. And, generated cash flow, and our EBITDA, adjusted EBITDA was around 20%. So we really had 3 messages that we wanted people to take out of our earnings call. First is that the business momentum in our business and in the industry in general is terrific. It was terrific in Q1. It continued into Q3. The second thing that we wanted people to know was that these projects that are going to fuel growth in the back half are on track, namely the opening of our Brookline dispensary, which we intend to open in June, and our commerce facility in Southern California, which we're turning on in June as well. So the projects that are going to fuel growth into the back half and beyond have turned on. And then we wanted to tell people about, the third, which is, what we call Big Daddy, which is our massive expansion in Illinois, which will start to drive numbers in 23. So as we look at our business, all the projects that we need to knock down and complete to set up our growth and really de-risk our growth trajectory, have been achieved and are on track in the case of Illinois. So we are pretty excited about, the setup of our business, the step function growth in revenue, and what that will mean for, incremental EBITDA as that top line ramps.
Mm-hmm. We saw quite the ramp up post-election all the way through January with quite the decline after that.
Mm-hmm.
You see the pot stock volatility coupled with crypto FOMO kind of taking away from investors going into cannabis stocks like 4Front?
Well, so when you had the special election in January and people saw the blue Congress, people got really excited that there were going to be reforms at the federal level in a hurry. And as an example, the biggest ETF covering U.S. cannabis or U.S. MSOs is called MSOS, and that ETF I think entered the year at around 220 million in assets, and in the middle of February it was at $1 billion. So all of that money came in and just jammed the stocks. And then you had some other stuff. You had you had more institutions. So Putnam is I have connections in the Boston and New York money management community, all who have owned our stock personally and were early investors. But Putnam started buying our stock in their healthcare funds. And so we started to see, some cracks in the wall, some plain vanilla institutions starting to come in. Wasatch, which is a really well-regarded mutual fund company out in Utah, they started coming into cannabis. And I think what happened was a couple things. I think legislation wasn't moving as quickly. So, that retail crowd that blew into the stocks kind of blew out just as quickly. And then you had some underlying things like Wasatch, who was putting real money to work to the point of, $100 million, I heard, investing in the cannabis industry. They got a tap on the shoulder and said, hey, you have to divest all your cannabis assets because all of a sudden our compliance department isn't cool with us owning U.S. plant touching businesses. And so that took a lot of just the air out of the industry. I would submit that there was a portfolio manager I worked with who's Dan Rice, who was an energy portfolio manager at BlackRock when I was there. And once in a while he'd come into your office and you'd say, why is this stock trading so low? And he'd say, Andrew, I think it's a gift from the stock market gods. And without any hubris, because the markets can do lots of things, but it feels like the setup for this space is just incredible. Like you can buy 50 to 100% top line revenue growth for profitable revenue growth for 13 to 14 times next year's EBITDA. That there's the inevitability of federal regulation changes seems like it's coming in the next 6 months, if not sooner. Mm-hmm. You're probably in the second inning of this expansion of the cannabis industry. It just seems like the setup for this, and then as soon as we get anything at the federal level, and I think banking is going to be really the straw that breaks the camel's back, is if we get banking regulations, that will eventually lead to, cost of capital coming down. It leads to allowance for uplisting on U.S. exchanges for us from OTC up to NASDAQ and NYSE. And then that leads the door open for institutions and their compliance departments to allow investment into cannabis stocks. And I think as a group, like assuming that the market doesn't totally fall apart, I think these things should trade at 30 plus times EBITDA, given their growth profiles and their cash flow generation. And you can buy this group right now for 10 to 15 times, and fundamentals are getting better, and you can see this wave of federal regulatory changes coming, and the inevitability of institutions coming in. I think it's a pretty powerful formula.
I would totally agree with you. And for some people who aren't aware of what banking could do, if the MORE Act or Safe Banking Act or anything that passes that has banking, and you can now write off employee wages and property tax, all these things, if you're an MSO, that's going to immediately improve your overall profitability. Mm-hmm. Right. So once you can write off things at 280E, you have all of a sudden a massive amount of profit, and I would imagine your stock price is going to reflect that the moment that banking is allowed.
Yeah. And just think of we've been financing equipment in our factories, in our facilities. Mm-hmm. We've been financing that with equity raises. That makes no sense. As an industry, we've had to dilute ourselves by buying things that are asset backed, that should be asset backed financing. We've had to finance with equity. Mm-hmm. And so that was sort of the first phase. And then the second phase, like, okay, well, we'll do some equipment financing for you, but we'll do it at 18%. You're like, okay. And now you're getting to a point where, the cost of capital for those financings are starting to come down. Even, 3 years ago, IIPR was offering cap rates, the 20+% range. Right now, they're kind of in the low teens. And I think that they, have to go lower still.
What'd you get for your Colorado facility, if you don't mind me asking? Is the rate still outrageous?
Well, we didn't have Colorado. We had Washington and Massachusetts.
Oh, I thought you were looking at Colorado real estate to expand in there. I was curious about their, because I know their real estate was absolutely ridiculous for companies.
Yeah, no, I mean the cap rates that we're talking about are kind of in the low teens. So not great, but not ridiculous. And you have to remember though that if we build if we win a New Jersey license and we build a cultivation processing facility in New Jersey, you have to remember that the internal rates of return on that project are nearing triple digits. So, once you start cash flowing out of that thing, you could probably pay the whole thing off in 3 years. So while, a mid-teens or low teens cost of capital seems egregious to folks, when the project you're putting into it has close to triple digit returns, all of a sudden you're like, yeah, okay, well, yes, we'd like to see the cost of capital continue to come down, but we can still make a really healthy return even at these levels.
This morning I saw that Apple had a rare downgrade, and I'm curious with the amount of prime brokers getting into analyzing and rating cannabis, like Bank of America. We even had Flora had an IPO on NASDAQ, the first plant touching company to have a direct listing on NASDAQ. I'm wondering if all of this is kind of getting banks, institutional investors on board. What is it going to be to finalize that? Because obviously they don't want to risk their charter. Is it a banking law that's going to get them finally on board and get the BlackRocks involved?
I think that it's really the compliance department. And I'll give you an anecdote. So I have a good friend who works for, I actually was with him yesterday, works for a fund company here in Boston that's got about 15 billion in assets. And they got really hot to trot on launching a cannabis fund, and had changed were ready to change their prime broker to one that was willing to process cannabis names. They were ready to go. And their outside counsel calls their compliance department and says, okay, so you're now on the hook for wire fraud. Is that what you want to be? And of course the compliance, the internal counsel sort of says, holy crap, no, that's not what I'm really scared. And so what I would submit to you is that compliance departments want to jump in the pool. You're seeing Jeffries, you're seeing Needham, you're seeing Craig Hallam. They have analysts covering the space, but they're not really in capital formation mode in earnest right now because, we want to give advice, we want to raise money. I think that when banking comes, you have an acknowledgement by the federal government that this is quasi-legal, even though it might not say that. Who knows what this Safe Banking Act is finally the final language is going to look like. But I think that it will give folks enough comfort. I mean, if not folks, internal compliance folks, I think it will give them enough comfort and enough cover your ass to jump into the pool. I think they're that close. And I think they're just looking for an excuse to make that leap. And I think safe banking is just going to be, pushing that snowball down the hill.
Yeah, maybe KYC should have been KYA instead of know your customers, cover your ass. Yeah, interesting. So I don't know. I don't know what's going to happen with the industry. I don't know if you've got any crystal ball predictions. Is there anything that you want to, throw out there that you think is going to happen? Obviously, you said legalization isn't going to happen for this administration at all, 5 years, maybe 10 years. We are kind of approaching that golden age of U.S. cannabis. Is there any crystal ball predictions you have that you want to include at this time?
Well, I think that increasingly you're going to hear people talk about low-cost production and the importance of that. because of the elasticity in the end markets, and you're seeing, when Boris from Curaleaf came out with the land they're buying in Colorado, just talking about low cost production, these MSOs, the bigger MSOs are going to have to start to tune into that, because making money in Massachusetts right now selling weed at $4,000 a pound is pretty easy. But as that continues to commoditize, they're going to have to sharpen their pencils, really sharpen their operations and get costs out. So I think that's going to be a really big deal, and increasingly a big deal. And there are companies, I think that we are probably, the top one or two low cost producers right now. We just need more scale. So I think low cost production is going to be a big deal going forward. I think that there's going to be a ton of consolidation in this industry over the next 6 months. From my chair, I am part of our business development team, and it is a very flirty environment out there right now. People are looking to, get scale, shore up their footprints, bring more talent into their and know-how into their organizations. And it's a fascinating time, right? Because here you have this $100 billion industry in the US, and people say, okay, well, who do you own? It's like, all right, well, I own GTI and Curaleaf and maybe Trulieve. And after that, there's a lot of money to be made in that sort of second tier who are coming on strong, like us, I think. So I think that there's a lot of money to be made in that second tier and investors. It would behoove investors to really look at who's been operating well, and, who kind of has room for step function growth and the commensurate multiple expansion.
If we were to peel a layer, an onion layer off and really look to see at what's driving low cost production, is it standard operating procedures, or is it competition? When we look at Oregon with 3,500 licenses and a crazy amount of overproduction, I look at Oklahoma and it scares me that they have 7,500 licenses. So there's a massive amount of consolidation that's going to happen in that state alone. So is it the competition that's driving the price down, or is it the improvement of operations? Where are you seeing that drive for profitability and low cost production?
Yeah, so in those West Coast states, so Washington and Oregon. Washington, I think they had 1,600 cultivation licenses. Don't quote me on that, but it's it's a big number. Mm-hmm. So these folks had come into the market, and you saw the wholesale price of weed go from $2,000 a pound to, I think it bottomed under $600 a pound. Mm-hmm. And most of the folks that applied for these licenses, or that were running these licenses, are sort of saying, we can't figure out how to make money at $600 a pound. And so they're leaving the market. And what we've done is we applied, low cost production methodologies, really applied from the seafood industry. The Gottmaker family is one of the largest seafood distributors in the country. So they figured out how to, package, how to buy efficiently, how to automate wherever they can, how to private label, how to white label. And we applied a lot of those best practices to the cannabis industry. And so we've figured out how to wring costs out wherever we could, and automate wherever you can. And I think that back to your question, your original question, competition starting to leave the market. Competition can't. We've seen the price in Washington rebound from $600 a pound up close to $1,000 a pound, because people are just leaving the market saying, "Shit, I can't make money at these levels." Mm-hmm. So that's kind of great for us, because we were making 25-30% margin selling weed at $600 a pound, and as that pricing goes up, that's all profit to us. So Washington is, as you know, a very competitive market, but our theory is if you can make it there, you can make it anywhere. Mm-hmm. And if you're just working in Florida, Massachusetts, Illinois right now, you can throw labor at the problem and you can still make plenty of money because the pricing's so good. But you're going to have to figure out, sooner rather than later, how to produce efficiently at scale.
Mm-hmm. Yeah, there's a lot of first mover advantages of being in business as long as you guys have, knowing the industry, knowing the markets. It's funny that you got some of your SOPs from the fishing industry, because we've seen some of the cannabis containers look like tuna.
Mm-hmm.
And it didn't work out very well. The branding didn't work out. People thought it was tuna, and so they've switched. So I just thought that was kind of a funny little comparison there. But
Yep.
Definitely some really good, phenomenal first mover advantages that you guys have. So I'm going to be excited to see where you guys move. As there is consolidation, that's going to create a substantial amount of opportunities for you guys.
Yeah, like this is there's no secret sauce, Josh. Everyone's like, okay, so what's the secret sauce to being a low cost producer? And it's really being an operator. It's bulk buying. It's figuring out the right strains. It's automating where you can. It's squeezing the labor out where you can. It's no one thing. And it really comes from, the skin, knees, and the learning of operating in a really competitive environment. We can take those lessons and we can apply them to states that are a lot less competitive. And I think it sets us up for not only taking a lot of share, but, allowing us to be the price leader, but also being very profitable at the same time.
Mm-hmm. Yeah. Exciting times. We're going to have your LinkedIn contact as well as 4Front's website in the description for the show notes. Is there anything else you'd like to plug at this time?
No, we really appreciate you having us on. We're just stay tuned for 4Front's, 4Front's entrance into the California market. We're turning on a facility which we think is going to be very disruptive. And as an investor, when you find companies that have a disruptive technology or a disruptive facility coming online, I think that it sort of behooves people to pay attention. So we're excited to see how California goes, but we love the setup.
Yeah, I'm hoping to get down there, maybe do an interview live at the world's largest production facility down there in California, with the 5th largest GDP market in the world being Cali. That's exciting.
Yeah, welcome anytime.
Looking forward to it. All right, I think with that, we're going to roll this one up. I want to thank my guest, Andrew Toot. He's the CFO of 4Front. Andrew, thanks for being on the Talking Hedge.
Thank you, Josh. Appreciate it.
I appreciate it as well. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.